All right, let's jump right in. We're going to talk about property giant GuocoLand's latest financial results. And, well, on the surface, they're a bit of a head-scratcher. It's a classic puzzle, really. How on earth does a company's profit go up when its revenue is going down? Let's unpack this thing.
So here's the core of the mystery. Right from their official report, look at this. Revenue, it dropped a pretty hefty 22%. Ouch, right? But then you look at the other side, and their profit actually jumped up by 14%. That is not what you expect to see. It's definitely not your everyday financial result.
So this immediately makes you wonder, right? What is going on here? Is this some kind of financial magic trick? Maybe just a weird accounting rule? Or is there something bigger, a deliberate strategy happening behind the scenes? Well, you're in the right place, because that's exactly what we're going to break down. The secret to cracking this code, it turns out, is all about understanding GuocoLand's core strategy. They call it their twin engines. Think of it like a hybrid car. Two different power sources working together, but each one doing a very different job. Okay, so first things first, let's pinpoint where that big revenue drop came from. And it turns out it's pretty much all down to just one of those engines, their property development side. Now, this is the part of the business that, builds and sells new condos and houses. But here's the twist. A drop here doesn't automatically mean bad news.
And why is that? Well, it all boils down to a kind of tricky accounting rule called revenue recognition. Basically, for a property developer, it's not like selling a coffee where you get the money right away. They can't just book all the cash from a condo sale the day it's sold. Instead, they have to recognize that revenue bit by bit as the building actually gets built. So that lower revenue number we're seeing, it's really more about construction schedules than it is about a lack of sales.
And this right here is probably the most important thing to understand. That official revenue figure is what you'd call a lagging indicator. It's telling you about the past. But if you look at what's happening right now with actual sales, what people are lining up to buy, the story is completely different. The demand for what they're building is actually incredibly strong. And hey, you don't have to take my word for it. Just look at the proof. This table lays out the sales rates for their big projects in Singapore. Check this out. Lentor Modern, Lentor Hills, Lentor Mansion, all 100% sold out, completely. And others like Springleaf and Penrith, they're sitting in the high 90s. So the sales are there. The deals are done. The money is just waiting in the wings to be officially accounted as the buildings get finished. All right, so that's engine number one. Now let's switch gears and look at the second engine. This is the other half of the story, the property investment part of the business. And if the development side is all about exciting big projects, this side is the complete opposite. It's the rock-solid foundation that keeps everything stable. You see, unlike that up and down, kind of lumpy revenue you get from selling buildings, this engine gives them a super smooth, predictable stream of income that's actually growing. Their rental income went up by a nice and steady 5% compared to last year. This is that reliable, month-in, month-out cash flow that really holds the whole company together.
And where does this steady money come from? It comes from their amazing portfolio of investment properties, like the famous Guoco Tower. Get this, buildings like that had a 100% commitment rate. That means every single square foot is leased out, no empty offices. So we're not just talking about income, we're talking about super high-quality, dependable income.
Okay, so let's recap for a second. We've got super strong sales on the development side, even if the revenue hasn't shown up yet. And we've got a growing, stable rental income on the investment side. But that still doesn't quite get us to a 14% jump in profit. There were a couple of other key things that really pushed the final number up.
And this first one is a really big deal. Their net finance costs, which is basically just the interest they have to pay on their debt, dropped by a whopping 30%. 30! They managed this by paying down some of their loans and also getting a bit of help from a better interest rate environment. That is a massive saving that goes straight into the profit column.
And then there were two other nice little kickers. First, their joint ventures actually started adding to the profit pile, contributing over $5 million. And second, they made a smart move by selling a hotel in Malaysia, which gave them a nice one-time boost. See, it all adds up.
So there you have it. Puzzle solved for their recent performance. But as any investor knows, what's already happened is only half the story. What about the future? Let's take a quick peek at how healthy the company is and what the road ahead looks like for them.
One of the best ways to check a company's financial health is to look at its debt-to-assets ratio. It's a simple measure of how much debt they're carrying. And for GuocoLand, the news is good. That ratio has gone down.
This tells us they're using the cash from all those sold-out condos to pay off their loans. That means less risk and more power to make moves in the future. You love to see it.
Now, it's also really important to know where a company is placing its bets, right? And for GuocoLand, it's pretty clear. A massive 75%, 3/4 of all their assets are based right here in Singapore. So what happens in the Singapore market is absolutely central to how they're going to do.
And that big bet on Singapore? It looks like a smart one. The outlook here is pretty positive. A stable housing market and strong demand for office space. That's a big contrast to their other markets. China's property sector is still facing some serious headwinds, and Malaysia is looking pretty competitive. So they're definitely navigating a mixed bag of conditions.
And all of this really brings us right back to where we started. The company's CEO, Sheng Jingyao, basically confirmed it himself. He said the twin engines are designed to balance each other out. The investment side provides that stable foundation. So, that financial puzzle we started with, turns out it wasn't some strange mystery. It was actually the company's core strategy working just like it's supposed to.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.